Hello, good morning to all. Welcome to today's Daily Dose of Market Insights by OANDA. I'm Kelvin Wong here, the Senior Market Analyst of OANDA Asia Pacific. Very good morning. Today will be Wednesday, 20th of December. So before we start our Daily Dose, let's take a look at the disclaimers slides first. All right. Leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exit deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice for any investment product, as well as any forecast, prediction, or projection in this document or presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so before we jump into the short-term technical outlook of the broad-based asset classes ranging from the major stock indices, the major FX pairs, as well as spot gold and WTI crude oil, let's recap the key events as well as data that actually has a significant impact on the broad-based asset class movement yesterday. That means, i.e., after the Asia session. So firstly, we'll talk about Bank of Japan. So that will be the last central bank monetary policy decision outcome before 2023 ends. So why Bank of Japan is important? Because Bank of Japan is only the last central bank that has short-term negative interest rates, and it has been keeping the short-term negative interest rates since 2016, which potentially may cause a bit of disruption in terms of desynchronization among the major economy. So yesterday there was actually a slight chance, only a slight chance, that potentially Bank of Japan could actually alter this short-term negative interest rate policy, or even signal that it could actually start to remove this short-term negative interest rate policy pretty soon. That means, i.e., coming into the first half of next year. Why? Because deflationary risk in Japan right now is pretty much remote, and the next step over here is that it is to be natural for them to actually start to remove or normalize their ultra dovish monetary policy, because it doesn't it doesn't gel with the current fundamentals. And also, do not forget the fact that the US Federal Reserve itself also will start to normalize its hawkish monetary policy guidance. That means having interest rates staying at a higher level for a longer period of time. That seems pretty much remote after the Federal Reserve dovish period last week. So that actually could potentially reduces the odds of global recession next year, prompting Bank of Japan to have a window of opportunity to normalize its ultra dovish policy in line with its localized fundamentals. But however, yesterday Bank of Japan chose to stand pat. They didn't actually alter their short-term negative interest rate, and as well during the release of their monetary policy statement 1 hour later, and also during the closure of yesterday's Japan stock market hours, which is at 2:30 p.m. Singapore time, BOJ governor didn't actually signal there's actually an imminent, we call it a potential change coming into play next year. So this was what happened yesterday. All right, so if you look at this over here, so he keeps traders guessing. I think that's what they want to do, as always, in terms of the BOJ guidance. So there's no clear yes or no, but market participants are still looking for a potential April removal. That means next April, coming into next April, potential BOJ will start to remove its short-term negative interest rate. So how does it impact the market? So if you look at the market yesterday, is that yes, there was a bit of slight disappointment from BOJ from the FX market point of view. The yen actually weakened yesterday, so that means, i.e., the dollar spike up, the dollar yen, that means the dollar versus the yen, spike up close to 1.9%. But what's interesting over here, despite this spike up in yen, it didn't actually alter the short-term downtrend that is still in place since November high, the dollar yen. So as you know that the dollar yen is one of the weakest FX pair for the month of November. So yesterday's short-term spike up didn't actually alter the dynamic of the short-term downtrend that's still intact of the dollar yen. And what's important over here is that for those who actually follow, listen to yesterday daily dose, I did highlight a key level to watch on the dollar yen, the short-term pivotal resistance, which is at 145.05. So yesterday, the dollar yen spiked up to 144.95, 10 pips right below the 145.05 short-term pivotal resistance that we highlighted yesterday, and shaped a bearish reaction of that during the start of the US session. All right, so it indicates to us that number one, yesterday's push up in the dollar yen is more like a blip of a noise within a short-term bearish dynamic that is still intact. So later I'll touch on more of the dollar yen story at that point in time. But most importantly over here is that yesterday's push up in yesterday's kind of a rather unclear signal from BOJ actually give a bit of spurt up on the Nikkei 225. That means our the Japan 225 we mentioned our platform. So right now the Nikkei 225 is actually retesting its current 33-year high. And don't forget, those who actually followed our quarterly outlook, which I give almost every quarter for some of the premium client. We did mention that the Nikkei 225 or the Japan 225 is one of the stock indices to pay attention to. Why? Because of its long-term bullish dynamic in nature. So later I'll touch on the short-term technical look on the Nikkei 225. So other key event to look out for is yesterday we have a Federal Reserve official spoke, or call it Fed speak. So over here, this Fed speak over here is from this guy called Fed Bostic. He's the Atlanta Fed chief. So you know that Federal Reserve officials, they actually have split into various states. So you have Fed Atlanta, Fed Cleveland. So yesterday, Fed Atlanta chief actually Bostic, he is one of those guys who was much more less dovish. So he made a public remark saying he doesn't see urgency to cut rate next year. All right, so he still said that inflation heading in the right direction, but it's still too high. And what's important over here that he did mention that he expects the Fed to actually cut rate only twice in 2024. Okay, so that was actually against the consensus thinking that was released in last week dot plot. So what is dot plot? I repeat again, dot plot is a kind of a median consensus where Federal Reserve of various Federal Reserve, all the Federal Reserve officials, including him, Fed Bostic has a chance to actually pencil down what is their projection for next year. So after removing all the outlier or this, so the median projection for the latest dot plot that was released last week was looking out for potentially 3 interest rate cut in 2024. So we know that Fed Bostic, after yesterday's remark, he's one of the outlier. That means the one that is not going with the generous consensus dovish camp by erring towards more of a cautious side. So he kind of stated yesterday's remark over here is that number one, he still thinks that inflation is too high, and also he did mention that most likely the Fed only cut twice in 2024 below the median projection that was highlighted in the dot plot last week, which is that looking for 3 interest rate cut. But all in all, that doesn't derail the ongoing bullish momentum that is seen in the stock market. So like I said over here, sometimes the stock market moves against Fed speak, it moves against fundamental, it moves against we call it logical thinking. Why? Because sometimes seasonality and momentum takes hold, which is right now is happening at this point in time. So it will be very much futile to go against such strong momentum at this point in time, at least in the short term. But bear in mind, we do have short-term levels to watch as well. So as long as certain short-term level holds, this potential momentum will be intact. How do we know what is the short-term levels? So every day in my daily dose of market insights, I covered all these short-term levels in the short-term technical outlook. So now, why market is actually rallying? Because of easing liquidity. So if you look at one of the easing liquidity factor, has a quick look at the US 10-year Treasury yield. So that is considered as a indirect way of looking at long-term cost of funding. Okay, so you look at the US 10-year Treasury yield has been inching downwards, and so far it's been trading kind of sideways below the 200-day moving average, with the next support coming in at 3.6%. Okay, so overall, what we could see over here is that this trajectory of the long-term 10-year Treasury yield indicate to us that further potential weakness, as implied by a technical analysis perspective. RSI is oversold, but there's no bullish divergence yet, indicating to us that this bearish downtrend that is in place since 20th of October high, I mean, this is close to a medium-term downtrend already because it's close to more than a month of down move, is still intact. That means, i.e., there is no bearish trend exhaustion yet which is actually supporting easing liquidity condition. So this from an intermarket perspective, also supporting this ongoing bullish momentum that is seen in the US stock market. So in the US stock market, a quick recap what happened yesterday. Yesterday, all the market continue its bullish impulsive sequence, with the top performer being the Russell 2000 up 1.94%. Why? Because Russell 2000 company is mostly consists of small cap company who doesn't have a very great, we call it positive cash flow to sustain their operation. They're more relying on long-term cost of funding. So i.e. with this ongoing continuation medium-term downtrend in the 10-year US Treasury yield, so that actually give a boost to the Russell 2000. So that actually explains their short-term outperformance. So followed by the Dow Jones Industrial Average, which is up 0.68%. Then the SPX up 0.59%, and the Nasdaq 100 up 0.5%. So bear in mind over here is that the Nasdaq 100 has really, the Dow Jones Industrial Average has really made its all-time high last week. So yesterday, the Nasdaq 100 pierced above its all-time high, doing fresh all-time high yesterday. So pretty much positive. The next up will be the SPX. So SPX is still 1% away from its all-time high. All right. So if you look at the SPX over here right now, 4818 was its all-time high previously in January. So this was in January 2022. So right now, based on yesterday's closing price, is close about 1% away from the all-time high. All right. So yes, a lot of people say that all-time high there might be a retracement. So to me, I will look at from an intermarket perspective, and also I look at the momentum. Does it show any signs of exhaustion? Unfortunately, no, right now. So I do not want to go against the trend and as well as the momentum. So I'll cover more on the short-term technical outlook. All right. So with that, this is the key. We call it events that took shape yesterday. That took shape yesterday. So now let's immediately dive on to the short-term technical outlook. All right. So let's start with the major indices first. Okay. Let us kickstart with the US market over here. Okay, so for the US market, let us start with the Nasdaq 100. Okay, so the Nasdaq 100 over here, previously 16,770 was the former all-time high. So 16,770, this is the all-time high printed in OANDA's trading platform, which is the US NAS 100, we call it our platform. So yesterday price action surpassed it and did a retest before shipping higher high. So for sure, this level here, 16,770, will be like a near-term pullback support level, but I do not want to target so tightly yesterday. So I'll use this much more pronounced former range, minor range top, now turns into a pullback support at 16,690. And also, if you look at the current impulsive up move from the minor impulsive up move from the low of 7th of December, all the way up to the current high is close to the 23.6% Fibonacci retracement as well. All right, so okay, let me expand my screen so you guys could see clearer. Okay, so I'll be using 16,690 Titan key short-term pivotal support for today, still maintaining that short-term bullish outlook. Next resistance to watch out for will be 16,950 / 16,990, a Fibonacci extension cluster, followed by a breakout above this level, potentially sees the next intermediate resistance coming in at 17,150 / 17,200. So that's also close to the upper limit of this short-term ascending channel that I draw from the low of 17th of December, and also close to a Fibonacci extension cluster as well. Short-term momentum going to, yes, it's overbought, but it's going to flash higher high in line with price action. So at most a bit of pullback before the price continue its bullish momentum, because there is clearly at the moment no signs of a bullish divergence. That means i.e. indicating to us bullish trend exhaustion. Okay, so we will have a Titan key short-term pivotal support for today, maintain that short-term bullish outlook on the US Nasdaq 100 at 16,690. Only an hourly close or breakdown below 16,690, potentially kickstart a minor corrective pullback within its ongoing short-term uptrend and medium-term uptrend to test the next support level at 16,430. All right, so that's for the Nasdaq 100. Now, what's next for the US Wall Street 30? So for US Wall Street 30 over here, price action going to trend higher and broke above the first resistance that we highlighted at 16,755. So this level has been taken out. So the next resistance to watch out for will be at 37,800. So RSI is at its overbought level. So as similar to the Nasdaq 100, no clear signs of a bearish divergence. That means there is low odds of a bullish trend exhaustion in the short term. So with that, I'll be using this level here. Okay, this first support level 37,430 as a level for it to see a kind of a pullback or a retracement. With this 37,180, so I will tighten it to 37,180. So 37,180 will be my key short-term pivotal support level, a tightened one, to maintain this ongoing bullish impulsive sequence within its short-term uptrend, with the next resistance to watch at 37,800. Above it exposes 38,100, which is a Fibo extension level. However, a breakdown below 37,180 will negate this or invalidate this short-term bullish impulsive sequence, or a minor bullish impulse sequence, to see a minor corrective pullback towards 36,970. Followed by 36,650 / 36,560, where potentially the 20-day, the upward sloping 20-day moving average could be coming very close to it in coming couple of days time. So with that, we were still maintaining that short-term bullish outlook, impulsive upmove sequence, as long as 37,180 short-term pivotal support holds. So if we start to see a breakdown below 37,180, it doesn't lead to a medium-term bearish reversal move. Why? Because price action is still holding above the 20-day MA, indicating to us that short-term uptrend still remains intact. So a breakdown below 37,180 will start to unfold a minor corrective pullback within a short-term uptrend. So I think this is the best that I could explain. Minor corrective pullback within a short-term uptrend, with the next support level at 36,970, followed by 36,650 / 36,560. All right. So that's just for the US Wall Street 30. Now, Asia indices. So in the indices, let me touch on the Hong Kong 33 first. So for the Hong Kong 33, price action still managed to pierce up above, yes, the tightened short-term pivotal support level that we have on the Hong Kong 33 index, which is 16,330. So 16,330. So this will be still a short-term pivotal support level to watch, with the near-term resistance at 16,890, which is also close to the downward sloping 20-day moving average. So you see the Hong Kong 33 index, the dynamics is slightly different from the US major indices as well as the rest of the world, because it's still trading within a short to medium-term downtrend, as being shown by the price action on the Hong Kong 33 still below the downward sloping 20-day moving average and the 50-day moving average. So let me stress again. In trading view, I'm able to overlay a longer term key technical element within a short-term chart. This is the short-term technical chart, a 1-hour chart, but I could do multi-time frame analysis on the 1-hour chart by overlaying the 20-day moving average and the 50-day moving average. So those who knows about trend analysis, as long as price action is trading below a downward sloping 20-day moving average and a 50-day moving average, and the 20-day moving average is below the downward sloping 50-day moving average, indicating to us that the short and medium-term downtrend is still intact on the Hong Kong 33. That means, i.e., whatever price action that we see so far from the low of 11 of December 2023 is more likely skewed towards a counter trend rebound within a short and medium-term downtrend of the Hong Kong 33. So given the fact that 16,330 still remains on support for the Hong Kong 33, we will maintain this short-term counter trend rebound scenario for the Hong Kong 33 index, with the first resistance to watch at 16,890. A breakout above 16,890 exposes the next intermediate resistance at 17,160, which confluence with two key elements: the downward sloping 50-day moving average, and as well as the 50% Fibo retracement from the last push down of 16th of November all the way to the low of 11th of December. If we start to see an hourly close below 16,330, then this short-term counter trend rebound scenario will be invalidated to see a retest at the major support zone of 16,100 / followed by 15,890. Right, so that's the short-term outlook on the Hong Kong 33. Now, Japan 225. So Japan 225 continued to pierce up above after that bullish breakout of its 20-day moving average yesterday. So right now it's approaching 33,825. So what's 33,825? 33,825 is in fact this level over here. So if you go to the daily chart, is a key range resistance. Okay, so this 33,825 is also a 33-year high on the Nikkei 225. Okay, we call it Japan 225 in our trading platform. All right, so hourly, if you look at this, the daily chart. So daily chart, the daily RSI going to shape higher high above the 50 level mark. Hasn't even hit the overbought level yet. So for sure, momentum still remains strong in the medium term. So there is actually a high chance of a breakout above 33,825. So if you look at the current situation right now on the hourly chart, so what I could do over here is that hourly RSI has started to come close to a overbought level at this point in time. So potentially there could be a pullback level over here. So the pullback zone could be at 33,857.20, followed by 33,350. This pullback zone. So I do not want to put it 33,350 as my Titan key short-term pivotal support for today. I'll use this much more pronounced one, which is formally tested 3 times, 1 time, 2 times, 3 times, 4 times, where we broke up yesterday, and as well confluence with this 20-day moving average as well. So 33,150 will be my Titan key short-term pivotal support for today. So as long as this level holds, potentially a break above 33,825 may expose the next resistance to watch out for will be at 34,200. So what's 34,200 is actually in fact a Fibonacci extension level. If I draw it from the low from here, okay, at 1.236. Okay, 1.236 Fibonacci extension. 1.618. Pardon me, 1.618 Fibonacci extension level. Okay, so this will be the next resistance level to watch after the breakout of 33,825. But however, if we start to see an hourly close below 33,150, then this bullish, we call it outlook, will be negated to see another choppy move towards the towards this lower limit of that range configuration at 32,840, followed by 32,560, which is also the 50-day moving average, I think, as a support, and as well as the former swing low, the minor swing low area of 14th of December to 18th of December. Okay, so still maintaining that short-term bullish outlook on the Nikkei 225 or the Japan 225 with a Titan key short-term pivotal support at today at 33,150. Okay, German 30. So German 30, yesterday we do have a neutral bias because of a mixed element. So price action now has already managed to clear above this neutrality level, upper neutrality level at 16,735. So with that, we will flip to a bullish bias over here. So using 16,635 here as a pullback level or a near-term support level for a potential pullback. Okay, so this is a potential pullback. So I'll be using Monday's swing low area here, which is this level, close to this level over here. Monday's swing low at 16,650. Okay, so this will be my short-term pivotal support level for today, 16,650. Okay, so this level over here will be my short-term pivotal support. So I'll be flipping to a bullish bias again on the German 30 after the breakout of the 16,735 yesterday. So as long as this level is not surpassed to the downside, which is also pretty much confluence with this upward sloping 20-day moving average, they're going to add as support in a couple of days. First resistance to watch out for will be at 16,910. Why? Because this level was tested on last Friday very closely before that pullback. A breakup above 16,910 potentially sees the next resistance coming in at 17,100, which is close to a Fibonacci extension cluster. Only an hourly close below 16,650 will invalidate this bullish outlook to see another round of choppy minor corrective pullback. That means this minor corrective pullback potentially could extend to test the next support level at 16,440. Pardon me. Okay, so flipping back to a bullish bias for the German 30 as long as 16,650 short-term pivotal support holds. Okay, so that's pretty much sum up for the short-term indices. So let us go to the major FX pair. So on the major FX pair, before we go into that primary, so if you look at the so this is the 5-day rolling performance of the major FX pair. So overall, what we could see over here is that the dollar continues to remains lackluster. against the sterling, against the euro, against the Swiss franc, the CAD, the Aussie, as well as the Kiwi. Okay, but this is the strong outlier push up yesterday after BOJ kind of disappoint yesterday, but that dollar strength momentum has started to kind of we call it erase itself during the US session, and right now potentially dollar yen is now shaping to push downwards as well. So net overall, we still start to see a lackluster dollar strength movement. That means potentially dollar weakness could continue at least in the short term on the average. So let's go to the European currency. So on the European currency, let's start with the euro dollar first. So for the euro dollar going to pierce up higher and almost hit our resistance level at 110.10/110.40. So with that, we will tidy up our short. So it could be still in a range. Okay, in a range. So we will tidy up our short-term pivotal support for today at 1.0890. So slightly above this level could be this level to watch for any potential minor setback or retracement at 1.0930. But I don't want to tie it so tightly, so I'll be using 1.0890 because it's confluence with much more key elements, which is the swing low of last Friday, okay, and as well as the 20-day moving average. I think as a support at the similar level. Okay, 1.0890 key short-term pivotal support. Maintain that short-term bullish outlook. First resistance to watch will be, the next resistance to watch will be at 110.40. So it's a zone now. So the upper limit of this zone, 110.40. A breakout above 110.40 sees the next resistance coming in at 111.30. All right, only a breakdown below 108.90 will invalidate this short-term bullish outlook to see a minor extension corrective decline to retest the 200-day moving average, also acting as a resistance support level, confluence as support level at 1.0820. Okay, so still maintaining that short-term bullish outlook on the euro dollar with a tightened key short-term or a tidy up key short-term pivotal support at 1.0890. All right, sterling dollar. So sterling dollar will still also remains the same, like the euro dollars potentially could be still inside the range. So yesterday the price action push up, attempting to hit our resistance level at 128 figure level. So still no change. I'll be using 126.10 as a short-term pivotal support level to maintain this short-term bullish outlook on the sterling dollar because it's confluence also with the 20-day moving average. Potential minor pullback level that we could watch out for will be this zone over here. Okay, at 126, 126.70 level. Okay, so I don't want to put it so tightly over here because 126.10 has much more elements that is pointing to this same level. Okay, and it's much more clearer. Why? Because this is a former minor range top breakout turns into a pullback resistance and confluence with the 20-day moving average. 126.10 short-term pivotal support, maintain that short-term bullish outlook on the sterling dollar. First resistance 128 figure breakout, potentially sees the next resistance coming in 128.70. However, a breakdown below 126.10 will potentially see a minor corrective pullback unfolding to retest this 125.45/125 figure support level, which is, I would say, this is my key medium-term support level. Why? Because it's confluence with this medium-term ascending trendline support that is in place since 1st of November, and as well as the 200-day moving average, okay, confluencing at this support zone here. Okay, so maintaining that short-term bullish outlook on the sterling dollar, no change. Now, what's interesting over here will be the Aussie dollar. Let me touch on the Aussie dollar first before jumping to the dollar yen. So Aussie dollar over here, what we could see is that it actually has already hit our short-term support resistance level, which is very close at 67.90. Why this level is important? Because 67.90 represents this major descending trend line that is in place since 25th of February 2021 high, as you could see over here as I extend the chart much further. Okay, so this level is pretty much important. So yesterday price action met this level. Yeah, we know that there is no clear exhaustion on the daily RSI. Okay, daily RSI haven't hit the overbought level yet, about to hit, but there's no exhaustion, no clear exhaustion in terms of this medium-term uptrend. So, but if you look at the hourly chart on the Australian dollar, as you could see over here, the RSI right now has started to actually, in fact, start to shape a potential bearish divergence. Okay, price action similar high. You could see similar high right now, but the RSI is now sloping downwards with lower high. So what we could see over here is that there could be a potential chance of a short-term bearish trend exhaustion. That means, i.e., a minor corrective pullback taking place within this medium-term ascending channel that is in place since 26th October 23 low. That means what I could see over here is a kind of a minor counter trend setback or pullback scenario unfolding towards the 20-day moving average that is still upward sloping. All right, so overall, the short-term and medium-term trend is still intact. Why? Because price action is trading above the 20 and the 50-day moving average, and the 20-day moving average is above the 50-day moving average, and both of them are still upward sloping. So any potential decline is only a minor counter trend decline or setback scenario. All right, so given the fact that because of this bearish divergence that was being flashed out on the hourly RSI, I'll be flipping to a short-term bearish bias below 67.90 because price action really almost come close towards the upper limit of our resistance zone that highlighted yesterday, 6745/6790. So with that, 6790 will be my short-term pivotal resistance for today. Looking out for a potential minor counter trend setback scenario. First support level to watch will be 67.30. A breakdown below 67.30 potentially expose the next support level at 66.70, which is last Friday swing low. However, if you see an hourly close above 67.90, then this minor counter trend decline setback signal will be invalidated to see the continuation of this bullish impulsive up move towards the next resistance level at 68.40, 68.70, which is a Fibonacci extension cluster. Okay, so now we reiterate, flipping to a bearish bias, but this bearish bias is not a start of a short-term downtrend or a short-term medium-term trend, because the short-term uptrend and the short-term and the medium-term uptrend still remains intact. So whatever bearish scenario that we're seeing right now is only a minor counter trend setback or decline. All right, below 67.90. All right, now I believe that I could make myself as clear as possible on this Aussie dollar strategy. Dollar yen. Okay, so for dollar yen over here, this is our 1 hour chart yesterday. So we adjusted our short-term pivotal resistance yesterday at 45.05. Price action reacted nicely at this level. It pulled back down. Right now, it kind of trades sideways. RSI right now a bit lackluster, and price action going to inch down lower and attempt to break below the 50 level. So what we could do over here, for sure, this is indeed a key short-term pivotal resistance where price action reacted for it. So this level, we will maintain this level. Why is it important? Because it confluences with a couple of elements. Congestion area over here, descending trend line from the high of 16th of November. And if I were to retrace the entire former down move from 30th of November all the way down to last Thursday low, it confluences at 38.2% Fibonacci retracement. Okay, so all in all, maintaining short-term bearish outlook, 45.05. Next near-term support level to watch will be at 142.30. A break below 142.30 exposes the last Thursday swing low at 140.95. Okay, so 142.30 will be pretty much key as well. So this is the 200-day moving average that was surpassed yesterday after BOJ disappointment. Okay, so with that, still maintaining that short-term bearish outlook, short-term bearish outlook on the dollar yen, as long as 1405 short-term pivotal resistance is not surpassed to the upside. So, but however, an hourly close above 145.05, then I got to respect the trend action, where we will start to see a much more pronounced counter trend rebound towards the next resistance level at 146.70. Okay, so still maintaining the short-term bearish outlook on the dollar yen. Now, going forward will be the commodities market to watch out for will be spot gold. Spot gold, no change, going to inch up higher above the 20-day moving average, 20-day moving average. So I will adjust today's short-term pivotal support right above the 20-day moving average, which was last Friday's swing low at 2015. So as long as 2015 holds, potentially the gold could see further potential. I'll still maintain the short-term bullish outlook on XAU/USD. The spot gold break up above this minor range resistance at 2047, exposes the next intermediate resistance to watch out for will be at 2067/2075. A breakdown below 2015 will start to see a massive minor corrective pullback within this medium-term uptrend to test the next support level at 1997, which is confluencing also with the upward sloping 50-day moving average. West Texas oil, WTI crude oil. So West Texas oil over here continue to trade sideways below the first resistance that we highlighted at 74.10 level. So still maintaining the short-term bullish outlook at 70.90. A breakout above 70.90 potentially sees the extension of this minor counter trend rebound scenario to test 78.40, which confluence with the 50-day moving average and the 200-day moving average. Only hourly close and a breakdown below 70.90 potentially expose the medium-term support level at 67.55/67 figure level. So that's the outlook for the West Texas oil. So that's pretty much sum up for today's short-term technical outlook. What are the key events to look out for today? So in fact, today there's a key event, which is the US inflation data that's going to be out later at 3 p.m. Singapore time. Market consensus is also expecting another lackluster inflation growth in UK, coming in at 5.6% year-on-year for the month of November, below 5.7 that was recorded in October. So if you look at the core inflation rate trend of in UK, it has been slowly inching downwards. So that is actually close to 1.5-year low. All right, 1.5-year low. So that seems to us that globally we start to see a bit of cooling off of global inflation numbers. So that actually supports a further potential easing from the US side of the story. That means lower 10-year US Treasury yield potentially also could lead to this ongoing risk-on scenario, at least in the short term. All right. So with that, that's pretty much sum up for today's daily dose of market insights, because I extend today slightly longer because I need to cover the short-term technical outlook for you guys to have a better understanding on the trajectory of this ongoing dynamic that is unfolding in the global market space. So with that, have a great day ahead, and we shall speak again tomorrow. Thank you.